All right, I want to welcome everybody. We're going to go ahead and get started. Tonight, what I wanted to do was kind of go back to one of my old favorite things, which is the egg. We've been doing a lot of work on this for the last really probably close to a year of trying to revamp some of what we've been doing with it and how we want to communicate more simplistically with it. One of the things that we're going to change is that we've really have limited it only to ETFs. And one of the challenges that I've had with doing that is volume. And we also are finding some stocks within the ETFs that we prefer rather than the ETFs themselves. And so we're going to actually introduce stocks into the mix of this. There still will only be one asset that shows up in the egg. So as we go through it, in the next 30, 35 minutes or so, and please ask questions as we go along. I'm going to stop a little bit early so I can answer whatever questions that you have, and we'll cover those. And then next week, I think on Wednesday night, we're going to do this again, and I'm going to take some of what we've done tonight and take it a little bit further into the trading aspects and how to actually build a portfolio using what I call a one-egg scan. So let's start with the premise of this, and that is that Warren Buffett was probably the most famous for saying, take all of your assets and put them into one basket and watch that basket like hell. And that was his famous quote when he first started managing, his fund. And when I look back on it historically, if you go back and look at how he's managed Berkshire Hathaway over the years, the earlier years when he had anywhere from 12 to 20 assets total were the best performing years that he ever had in the history of what he's done, versus now where he can have upwards of 150 to 200 various holdings, and the performance of the assets has lagged. So there's a lot of psychology behind both arguments to diversification of assets versus non-diversification of assets. And, people have developed all kinds of things, whether it's Monte Carlo simulations and various sundry other issues. But what I have found, even in my own trading, is the less assets that I hold, the better I am at managing those assets, and the more disciplined I am at managing those assets versus allowing things to bump around and run into the walls and all the other analogies I could use. But I think that by the time we're done with this presentation, one of the things that I want you to get is that this really does have to become simple. So I'm going to go back. This is just Telechart software, and one of the things that I have built is a desktop inside of here. I call this a one-egg desktop. And what I'm going to try to do is go through kind of the premise of how this has evolved over the years. And how this started was with the S&P 500 index. And I want to go back probably 22, 23 years ago, maybe a little bit longer ago than that. We used to do a lot of money management processes and financial planning, and one of those was dealing with 401k assets. And so what was a challenge was everybody had a different 401k plan, whether it was managed by Fidelity or Vanguard, Principal, or a myriad of others. And it made it very difficult for me as an advisor to say, I have hundreds of people sending me their 401k plans and trying to balance them out. So we tried to come up with a simplistic approach to how do we manage money within a 401k that makes it easy for everybody. And I'm going to go to a weekly layout here just quickly, and then we'll flip even further back into a monthly layout. But what we started to look at was the longer term of the trend, or the longer cycle of the market that you looked at. You could really manage it with one asset, which was the S&P 500, which at the time Vanguard had the Spartan 500 fund. SPY actually came out in 1991, so that's been around for a big chunk of the time that we've done this. And so we decided that why wouldn't we just manage this in one bucket because the S&P 500 accounts for approximately 75% of all the U.S. equity asset classes, and it does it very efficiently. It does it with large cap stocks versus mid and small cap stocks, so everything in it has a large capitalization size. It just made a lot of sense to do it this way, and we back tested going all the way back to 1920 whatever, and brought forward different studies of different ways that we would use entry and exit signals relative to the S&P 500. Now, if you take this back to a monthly chart, and you can see that looking at this, going back to the big correction back in the 73, 74 time frame, you can see that when you take a longer-term view of the S&P 500, it actually trends very methodically, and there's certain things that we discovered within it that worked very well, and there were certain parameters that we plugged in around the monthly chart that gave us entry and exit signals relative to the S&P 500. We still manage this model. It's been around for 22 years. And it's averaged through thick and thin, through all of this, just over 13% per annum for 401k money. And, some people say, well, that's not that great. Other people say it's fantastic. It's all perspective. If I could average 12% on my money over 25 years, and I'm constantly adding to that portfolio over my lifetime for retirement, I think it works extremely well, and it has worked well. So that's the evolution of where we got the egg and how we developed it. And by the way, the egg did miss this drop, and it missed this drop. And so it took out the two biggest drops, and if we scroll back, it actually missed the 73, 74, and missed the 82 correction, the 87 correction. And the reason being is how it's set up and how the signals take you out of the market based on momentum downside within a specific period of time relative to long-term charts. So we took that and said, can we condense the periods, and can we make it so that the signals on this are faster in shorter cycles, and can we apply that to trading? And it took several years to actually work through all the models, the bugs, losing money, trading money, and coming up with what we felt was an applicable methodology for managing the assets. So when we look at the S&P 500 today, it still has 10 sectors. It originally had 9 because telecom in the original components, as they were built by the S&P, lumped telecom into the utility sector. So because at that time, a lot of the telephone companies were considered to be utilities, and as they grew out of that and became more of what they are today, and more, I think they have more of a tech bent today than they ever have, but that was created to be its own sector by the S&P 500. So it's always had that component, that flavor, and what we did was look at the S&P. Now, here's the two driving components, and if you've heard me speak before, you know that I talk about inside the market event and outside the market events quite a bit, and what the focus is to say, all right, what's going on inside the market? There's two things that we look at inside the market. One is fundamental, and two is technical. Fundamentals are based on the economy, 1, and earnings, 2. So when you look at what's going on within this component, what we're looking at here is whether or not you can actually take the assets and break them down. I'm trying to get my pen here if I can get it. There we go. So what I want to look at is, so I've got the fundamentals, which is what the one piece of this on the inside of the market, and the other is the technical components. Now, from a fundamental perspective, all we're looking at here is the economic events, so the economy and earnings. And those are two key components. And here on a technical perspective, we look at only two things. We look at trend, and we look at, you can call it volatility, or you can call it sentiment, whichever you'd like. Some people use them interchangeably. Some people describe them completely differently. But what we're looking at is what's the sentiment or the volatility of the market relative to the trend. And that essentially is an inside market event that we look at every day. And if we were to look at this period right here, you can tell sentiment becomes accelerated on a short-term basis. The trend at that point was up, broke, reversed, and came back. We look at that, and then on the economy and the earnings, we could tell what was going on here. And everybody knows what happened in February. This was Fed-driven. So this was an outside market event. These are inside events, and inside events deal with the market. Outside events, if we go outside the market, those events really revolve around news, and that was news. The Fed revolves around analysts, which I'm not a big fan of, but there are a lot of them around. And then it also revolves around politics or geopolitics around the world, which is Russia and the Ukraine right now, which is an issue that hangs over the market. So when we break the markets down on a daily basis, those are the key components to me that I want to see. I wrote an article tonight that I posted in the notes, which is, what's the story of the market? In other words, what story is the market telling you right now? And these are the two things that I look at and say, are there outside events that are going to play havoc on the market? And is there anything inside the market that is going to determine where this goes looking forward? Because that's what we're going to do. We're going to take what the market's done technically, we're going to look at what it's done fundamentally, and we're going to prognosticate forward what we think it will do based on outside market events that could be ultimate catalyst or events that take place in the market that shift the trend. And so that's just as simplistic as I can make it. There's a lot of tools and things that go around that, but that's where it is. Now, if we step away from this, and let's go to another desktop here, and I want to go to the scatter graphs, and I want to look at that there are 7 asset classes, and here they are. And each of these asset classes we define by using ETFs because it makes it a little bit easier to see it. But VTI is the total stock market ETF for the U.S. markets. So you got U.S. equities, you got EEM, which is the emerging markets, EFA, which is the developed markets globally, TLT, which is U.S. treasuries or U.S. bonds, EMB, which is emerging markets bonds, and then you have the UUP, which is currency, and DBC, which is commodities, and IYR, which is real estate. So there's 7 asset classes, and that incorporates everything that's out there. And what we look at on a daily basis is what's happening within the asset classes and what's the story. Why are they, why were emerging markets moving up? Why are they moving down? Why would treasury bonds be moving higher? Which I have my own opinion about that right now, which, by the way, for those of you, this is just off the beaten path, but some people don't look at this very often, and we look at it every day. The 30-year Treasury actually hit a new low on yield today that it hasn't seen going all the way back to June of 2013. And so, we're almost a year since we've hit these levels, and we came off of these lows and escalated off of that. We've broken support. Money is rotating to bonds, which tells you the market is creating. This goes back to the inside market events. The sentiment of the market right now is building on the fact that bonds are prognosticating that stocks are going to correct. Money is moving to safety, and it's rotating probably more dramatically than a lot of people, me included, believed that would happen in the first third of this year, which is a very interesting event. But you've got bonds moving up, you've got the currency flat, and so what's happening is you get a picture for what's going on, and you start to actually build why and what you want to scan in and around and through the markets, and that's really, to me, those are the key components, is knowing what's going on inside the market, outside the market, and defining why it's happening now, and then prognosticating forward without speculating. And there is a distinct difference between the two, and I covered in tonight's video that I posted for the market updates today that there's a way that you can speculate in the market right now of what you think is going to happen, and I hear it on CNBC and everything else throughout the day. But for me, I want to know that my probability of the trade is a low-risk probability. It's a risk that I can manage. speculation. So that's prognostication. When you speculate, you're taking the risk parameters of what you're doing and making them so large that it's going to be very difficult for you to control them. So the first part of what I wanted to say tonight is just this, is that's the broad overview of how I do pretty much anything and everything in and around the markets when I look at things on a forward-looking basis. Now, where do we go from here is we dig into it and we say, is there a trading opportunity based on pivot points relative to these? And you can see I've kind of flagged some pivot points in here. And one pivot point that I wanted to drag this back to is you can see that U.S. equities peaked right here on 4.7 and Treasuries bottomed on 4.7. And if you look at those two charts, they've actually have reversed directions. U.S. equities had moved down to sideways where Treasuries have moved up to sideways, meaning that there's a rotation to safety. And when money comes out of safety, you have to understand how to extrapolate that out. In other words, if money is rotating, it's telling you that fear is creeping into the market, and it may be anxiety, uncertainty, or whatever we want to call it, but fear is coming into the market, and it may not show up in the volatility index. It may not show up in sentiment until after it's become full-blown, but you start to see it develop within the charts. And the money rotation to Treasuries, to me, was a big worry relative to U.S. equities, which you can see what happened right in here with U.S. equities. But let's go back over here to the other desktop and look at a couple of things that came out of this. And that as that money started to rotate out of stocks and more towards bonds or safety, then what should be happening at the same time is that at that same time frame, what we should be seeing happening is money becoming defensive. In other words, you should see ETFs like IYR, which is the real estate REITs, you should start to see money rotating in that direction. And what you've seen essentially is exactly that. If you look right here off of that cycle, money rotated into real estate. Now, by prognosticating, I'm trying to get in front of what's happening. And this is where this is how we evolved to the egg. And I'm giving you how we drill down or dig down or filter or scan or look for where we think money is going to rotate and how do we track or scan for that rotation to take place. And that's exactly what it is that we build the story of the market and then we unfold it and we fold it back until we can find the pieces that make the most sense. And IYR obviously made sense out of that. We own IYR right now off of that. The other one was utilities, which is a defensive sector. And you can see the same issue in that we started to rotate out of this and we started to see money come up into utilities. And they've, IYR is the number one performing sector for the year since January, up over 10%. Utilities, which you can see if we go back to the January timeframe, this is up right now almost 16%. So you're starting to see where, and then the other piece of this was XLP, which is the consumer staples, are what I call the toilet paper stocks. You can see the bottom and the reversal back to the upside in XLP, and you get the picture of what was going on with this. So that's one part of it is digging into that. And of course the question is going to beg, well, how do you track that or how do you scan that? And I'm going to pull this over because these are the scans that we have built. One's called the egg scan for negative sectors and one's called the egg scan for positive sectors. And all this scans is the total ETF universe. We have another scan that we run that's not on this desktop, that we run all of the asset classes that are measured by, or industry groups is what I should say, by Morningstar, because Morningstar is who Telechart uses for their industry groups. So there's no magic to why we use Morningstar's industry group. It's just that's what is in Telechart. And if you go into Telechart under the watch list right here, you can see industry indexes. And if you click on it, there they all are. There's 146 of them measured. And I can scan those, and I can filter them the same way that I filter the ETFs. Now, why do I bring that up? Because historically, what we've done with the egg since we created the egg model 7 years ago, we created it specifically for ETFs. Now, because we can, one of the things that we've looked at is that, sometimes we get thinly traded ETFs, and it's very difficult to buy or sell them. On the opposite side of that is that with scanning the ETFs, we find stocks that are in them that offer great opportunities, and some of them are large cap stocks. They're, one recently that came up on our scan was ExxonMobil, ConocoPhillips. We've had a lot of energy stocks with what's going on right now popping into that, and they're large cap stocks, extreme volume, and it's been a lot easier to trade the stocks than it has been to, in a lot of ways, to buy and hold XLE, which hasn't given, XLE's up about 7%, where we've made on some of the moves in Exxon and Chevron and some of those stocks, we've made 8% in 3 days. So we're seeing faster acceleration in the stocks, which is obviously normal, but we just acquiesce to the fact that we thought it worked and we wanted to do it that way. So what we've done is gone into these industry groups where if I click on the first one here, you can see it's banks regional for Europe. And you can see that banks in Europe are starting to break out. Is there a way for me to buy that? And you can see over here that there aren't very many U.S. trading stocks in this group, but there are enough, and they are moving, and I can actually go over and look at some of these and say, do I want to own any of these? Do I have a volume issue? How do I look at it? But it gives me the ability to actually dig into personal services, which is consumer cyclicals, and look at what stocks are moving. So I'm not going to belabor the point, but the fact is that, so we built positive and negative scans for both the asset classes and for the ETF. So we still scan it the same way we've always scanned it, but we've introduced scans into the actual indices themselves, which creates a whole other issue, by the way, but without getting into that, which is off the path. So what we're going to look at tonight is that one of the first things we look at is we run the scan and we see 116 ETFs come up on the scan. The more negative or the more the sentiment starts to shift and the more volatility that comes into the market, the lower that number goes. The more the trend moves sideways, the more stagnant that number becomes on a day-to-day basis when we run the scan. So if there's 100, 101, 102, 99, 98, 103, we know that the market's starting to trade sideways, but even within the sideways motion, there's positive momentum within some of the sectors. And what also starts to happen as you get a trend shift is the number of negative scans come up, the number starts to rise. So when we run the scan, matter of fact, when I ran the scan last Friday, that came up with 1. Matter of fact, on the negative scan, I had 1 ETF, and on Thursday I had 0, which tells you that we were in a bottom bounce momentum, and it took the negatives out of the market. But on the positive side, that number had jumped to 218, which you can see when we run it right now, it's at 116, which means some negative. Even though we've bounced the last few days, you still don't have a lot of positive sentiment in the market. So it always gives me a feel for how the market's functioning on a day-to-day basis, which to me is very key for how I see, feel, and interpret the market. And I say feel because everybody's got emotions involved in this game, and confidence comes from knowing. And the more you know, the more confident you become. The less you know, it's very difficult to pull the trigger, especially in choppy markets like we're experiencing right now. But you can see coffee obviously has been one of the better performers. Now, what I want to do is go through this because you guys can run scans however you run them. You can do different things. But there are things to me that are so simplistic that people fail to use that it just boggles my mind. But I try to keep it simple. I don't use a lot of indicators. I use price, I use volume, and I use a couple other things that I look at, and I toy with things around. But I don't use a lot of things. I want to know what I know, and I want to know it very well. And I can't know 72 different indicators very well. It just doesn't work that way. So the way I see this is that you have to kind of step back and look at what's happening. So let's go first here. Let's go to the S&P 500. And here we're looking at large cap stocks. The S&P 500, the momentum to me still is on the positive side, even with this dip that we've had. The S&P is on a positive bias. You got rotation to dividend stocks. You got a lot of reasons the S&P has a positive bias along with the Dow. There's a lot of reasons why you've got a negative bias with the NASDAQ Composite Index because high beta growth stocks, which it's compiled of, are out of favor and people are selling them and they're buying. We've seen a significant rotation in the last 3 to 5 weeks out of growth stocks into value and into bonds. Look at the bond funds. Look at LQD. Look at MUB, which is LQD is the investment grade corporates. MUB is the municipal bonds. Look at money rotation. Look at PFF, which is the preferred stocks. Look at the money rotation. Look at XLU, XLP. Look at the dividend sector, or the dividend and large cap and the defensive sectors. Money is rotating there. It hasn't stopped. It's still coming there. And today's jumping, or we dropped 5 basis points in dividend yields on the 30-year Treasury today. We dropped 5 basis points yesterday. We've fallen 10 basis points in 2 trading days where we've fallen to a 1-year low on dividend yields. Money is rotating. And that's where you have to understand what's going on with the markets on a day-to-day basis. And if I were a philanthropic and had nothing else to do every day, I would wake up, I would have an 8:30 webinar for a half hour every morning from 8:30 to 9 o'clock, and we would talk about what to expect in today's trading day based on the things that we started this webinar with tonight. What's going on inside the market, outside the market, how does it going to impact technically, fundamentally, and what news, politics, or events are out in the marketplace that we have to be worried about impacting the market today. We had one yesterday, that was the FOMC. We had one today, that was the ISM manufacturing numbers. We got one tomorrow, and that's going to be the jobs report. The jobs report, if it's negative, if the number's less than 150,000 jobs added for the month of April, I believe the market will implode on itself. We own a lot of cash right now. We're over 80% in cash. And I do not think that the market is setting itself up for a lot of success, but it's giving great trading opportunities that you have to kind of take the good with the bad. So what you're looking for is coming into the market every day is what's driving this and why is it driving and how can I benefit from it on a day-to-day basis. And so I'm going to give you 1, 2, 3, I think I have 3 things here today that have happened recently that I think are extreme examples of what's going on in the market. But before I do that, I want to go back here one quick second. These columns that I add in here, and if you see, that's percent change for the last 5 days. This is percent change for the last 10 days, percent change for 21 days, and percent change for 63 days. There's no magic to those numbers other than that's a week of trading, 2 weeks of trading, 1 month of trading, and 13 weeks of trading. So it gives me what it is. I can filter these by the last 5 days. If I want something that I need to know, and here's where I think that the simplest thing in the world is what I'm going to show you right now, which is you can come in here, you got custom date sort on Telechart. We had an intraday reversal on Monday. And so Monday gave an intraday reversal relative to what's going on. Now, if I want to, I can filter this down by doing this. I can go back to the 60 minute charts. We go back to Monday's intraday reversal, which is right in here. You can see the reversal. And I'm going to come back in here, and I'm going to take the custom date sort, and I'm going to grab it right here, and I'm going to bring it. I just want to come forward intraday. In other words, I want to figure out, hang on one second. Let me go. I want to go from here on the reversal to here on the close. And that was a gain of 0.33%. And then you can go in and you can build this custom date sort, and you can actually figure out what sectors outperformed on the intraday reversal. And then you take those sectors and you build your watch list going into tomorrow's trading day. So all you're doing is saying what were the best performing sectors relative to the market itself. And I want to take those sectors, pop them into a watch list, and now I want to be able to take those sectors and define who are my best trades. And coming out of that, what we defined over the best trades was, one was the Dow Diamonds, two was the NASDAQ 100 index, and then we went and we gave you two stocks. If you go back and look at Tuesday morning's trading notes and Monday night's video and Monday night's notes, I wrote in there, here's what you need to look at. The Dow. And the Dow is ready to reverse. It gave you an entry point and how to trade it. It gave you one for the Qs and how to trade it. It gave you one for Google and how to trade it. And so that's all we're looking at, is where can we find opportunities within these. So if you want to trade the Qs straight up, you have less risk. But if you want to leverage it, you go to QLD, which is the ultra version of that. So the Qs are up 1.5%. QLD is up almost 3%. If you did the trade on the Dow, it was only up 1.3. If you did the leveraged version of the Dow on the upside, which I think is DDS, and got 2 times leverage on that, then that's up roughly 2.2%. And Google was up. I know what the option trade was. I didn't trade the stock. So the option trade on the June calls, 520 calls on Google, we closed it today for a $3 profit and it cost $18 to buy it. So $3 on 18 is, again, 15% return on the Google trade. All those trades came from an egg scan. In other words, when I put stuff on the website, or I am trading in my own portfolio, trading for other people, I see trades by using egg scans. It's my best tool for simplifying the market for me. And I've got, we could go back and look at how many easy scans and all watch lists. I have thousands of these things. And, I always, every day, come back to the egg scan. Why? It's simple. It's so simple. I get it. I trust it. I trade it. I like it. And I do it every day. And I've gotten to the point where it's almost the only thing I do in my own account. And the reason I haven't done a lot of webinars is I've been working a lot with a lot of this stuff myself in my own account. Haven't really talked to a lot of people. I've been focused on how do I get better at what I'm doing, because we found ourselves, our trade success ratios were going down. And the reason we're going down is we're trying to do too many things. We're getting too filtered out. So I had to cut everything off, condense back down, and say what works. What works is the egg. And it's always worked. It's worked for me for 23 years. It's worked for me on the website and the model. It's worked for a long time. And I continue to look at this from the standpoint that we make, and a lot of people make trading way too hard. And so I'm going to be doing some classes. I'm getting ready to publish a couple of ebooks on some stuff about the psychology of trading, habits within trading, how to train your brain relative to who you are, how to find trades based on who you are. And in all of this, I had to come back with a simple trading methodology, which to me is the egg. It's I don't know how else to say it, is that we find things that are simple by doing things that are simple, and we make actions simple by trusting what we do. It's when we get convoluted and start going out and doing, I listened to a webinar by someone the other night on candlesticks and the 7 best patterns for candlesticks. And it was very well done, very educational. And I found myself thinking, well, maybe I should be trading dojis and haramis and salamis and, suzamis or whatever. But by the next day, I was like, forget it. I need to do what I do. I need to focus on what I am good at and not try to be all things to all people, because I'm never going to succeed at that. So what my point of 3 things here that I see that we've seen, and this one's still going on, these stocks had not really participated in the upside, and the period of time that we're talking about is right in here. This is what we're talking about. If we put another chart in here, let me do that real quick. What you see when I sit these two side by side is you can see right here, natural gas exploded, natural gas stocks went sideways. That's called divergence to me. I mean, in other words, you've got discrepancy in the market in that if the commodity is exploding, the stocks are going to benefit from that. In other words, ExxonMobil just had a announcement today talking about that they are finally reaping the rewards of natural gas to their bottom line and to their revenue stream. And it was a very well done analyst article on ExxonMobil, because if you go back, ExxonMobil about 2.5, 3 years ago made a big acquisition. They bought one of the biggest natural gas producers in the world. They needed it because they felt they needed to diversify from crude, blah, blah, blah. Well, what that article by that analyst today verified is that Exxon was saying, look, our stock hasn't been rewarded for what we have reaped out of this on natural gas, and now it is being rewarded. And so what you've seen is the natural gas stocks spike up. They've gone from 1925 to 2275, and they've had a big run. But that's something that if you had it on your watch list, you can look at this and say, well, natural gas stocks jumped 18.4%. And if you look at natural gas popped up almost 56%. So there's still room inside of the stocks relative to the commodity for opportunity and upside. And now you're getting another reason. And that's the other thing, is that when you own some of these things and you get stopped out of them or you taken out of them, you got a flag, you get a continuation breakout. You got another pennant forming here that my bet would be you get a continuation breakout until you start to get this coming back into the stocks, which is natural gas is planed out, and eventually this will plane out. But you've got to gain that value back into the positions before it planes out. And my point continually to people is the market tells a story day in and day out, and there's tremendous opportunities. I mean, if you look at FCG, the problem with FCG is the options on FCG are too illiquid. But if this was an ETF that had ample option contracts, I could have gone in and built a big option position in FCG where I had to spend $20,000 on the stock. I could have bought the 1950 or the $20 call options going out into a leap 1 year out, and say I want to own those call options out. I'm in the money option. I'm out a year, and I'm going to try to treat it like a stock trade, but I'm going to leverage it up with options. That trade, I'm just going to tell you right now, that trade would be huge, but we had to buy the stock because the options were too thin. But the issue continues to be, how do you find these things? Because now, let's close that because I don't need that. And you come over here, here's FCG, here's your natural gas stocks, and you say, all right, got to link this back. Here's Anadarko Petroleum, and Anadarko back over in here started to break out. Now, this stock does have options, and this stock is very liquid on the option side, and so are some of these others that are up here, Cabot Oil and Apache, and you can see what's happening to these stocks. Some of them are actually have taken off. Stat Oil to the upside. And there's just a lot of trading opportunities within this egg. So even though I got an egg, I've got a lot of eggs within the egg. And so that's where we wanted to make a transition to how we do this is, it's great. I own FCG. I'm going to make 15, 16% on my money by owning FCG. But why shouldn't I make more money? Because I'm already in a sector that's moving, and I'm already in something I know something about. I've already seen the discrepancy. I have the conviction, and I own the position, and I can make money, and it works. The other one that we've seen is oil, and we had crude jump, and the oil stocks did not. If we put up XLE back in January, you can see on XLE, here's January. It actually fell. So at the same time that crude oil was rising, oil stocks were falling. Now, if that's not divergence, discrepancy, or stupidity, I don't really know what is. But the oil stocks were out of favor. I mean, we could go back and look at all the reasons and rhymes why, but they fell. And so here's your opportunity to add into XLE and wait for the energy stocks to catch up with the price of oil, which they now have. But look at the trade that created. Look at the option trade that came off of that. Look at the opportunity that was there. And, so when I look at these things and the fact that, there's a lot of unique things going on in the marketplace today that are creating, I think, dynamics for trading opportunities that people are missing on a regular basis. And I see them. I see it right now. One of the ones that I own a small position in this, which is the emerging markets. Once Russia gets out of the way, once the Ukraine, whatever they do, whatever dance they finish over there, and they get out of the news, whether Russia bombs them, takes them over, enslaves them, or whatever they do, whatever embargoes we're going to take on, and whatever whatever our president thinks he's going to do to Putin to convince him not to do that, which is not going to happen. Whatever happens. It's out of the way. Emerging markets are ready to move. The currency issues out of the way with the emerging markets. The euro has settled down. Russia's the only wild card in that whole picture. But you have to like what's going on in the emerging markets. And this is one of the most undervalued sectors out there today. And people don't like it. They don't want to talk about it. And if you look at these charts of EEM, we're still in a very defined downtrend. We've had a huge volatility, but if you back into this chart a little bit longer term, change this over to a weekly chart, look at this huge consolidation within emerging markets. We've had no movement. We actually have this elongated, consolidation triangle that's developing. Everything's gone flat on stochastics. But if this breaks out to the upside and starts to clear a couple of these resistance points on the upside, I think emerging markets runs, and I think that a lot of people are going to see it after the fact. But I'm just telling you, it's not there yet. It's trying to get there. I got things in the way that are outside market events. The inside market events relative to the emerging markets are ready to go, but the outside market events are holding a blanket over. When the outside market events remove themselves, emerging markets will have their day. The other one that's going to have its day is Europe. And Europe is already broken out. It's already moving up. I do own a little bit of this, and I still like it because Europe's going to go through what we went through in 2010 and 11. They're following the same path. They're doing the same things financially within their financial systems. Europe is healing. Europe is going back to work. Europe's GDP is improving. Matter of fact, Europe's GDP for Q1 was better than the United States, which is mind-boggling. 0.1% GDP has got to be the biggest joke I've ever heard of. And the fact that we added, we totally revised GDP calculation to make it look better, and it still blew up. If we hadn't revised it, we would have had a negative 2.7% GDP for Q1 under the old methodology. Europe's doing better. China's a short. Japan is, I don't know where that's going. But look at Canada. Look at Australia. Canada's starting to break out. Australia's starting to break out. Why you're seeing the EFI index move. Latin America's moving. You're starting to see the global markets come into play, and a lot of people are still focused on the U.S. I think you're going to see a big global market play evolve out of this. Where did I come up with all these things? I came up with all these things, one, because we look what's going on inside the market, outside the market, based on 7 asset classes. The 7 asset classes include everything that's out there. We start with that. We filter to the class that evolves to the top. We look at the outside market event, what news and events are out there, politics, all of that could impact those turns. And then we look inside the market, fundamentally and technically, is anything going on that's attractive within these asset classes? And then we start to dig down. That's as simple as I can make it. I can't make it any simpler. And yet we still, I wish I had $1 for every email I got just today offering me a webinar on a triple Lindy with a double backflip, how I trade this and do that, how I do this and do that, and how I do this and do that. You know what? When you chase things, be careful what you chase, because if you catch it, you may not want it. What I'm saying to you, this is about lifestyle. This is about sanity. This is about simplifying it down. And if I have any other message for the rest of my life, I'm going to do my damnedest to stay on this message. Keep it simple. Keep it simple. Keep it simple. The simpler it is, the easier it is to follow. And the easier it is to follow, the easier it is to implement. You know, how much, I don't know how many of you listening to the webinar tonight, remember when you actually could open the hood of your car and actually see the engine. That was a simple way of driving. But then we got EPA standards and we got all these things. And now you open up the hood, you got to have a computer science degree to turn your car on, essentially. And it's gotten too complex. And what is happening in the markets today is the more ways that we think we can beat the market. I made a decision 15 years ago, and I can remember the day, I remember where I was. I'm not in this to beat the market. I'm in this to create a lifestyle for myself as a result of investing in the market. If I go to the market every day and I want to beat it, I'm going to turn into Jerry Springer, because I'm actually going to go nuts. And you have to really kind of back away from this whole thing of beating the market and focus on what is the market about. The market is inanimate. It doesn't care about you. It doesn't care what you think. It doesn't care what you believe. My focus is, how do I partner with the market so that I get what I want from the market? So here's what we're going to do. We're going to start delivering more webinars. If you want to be on the email list, you need to sign up for the email list. We're going to start publishing, we're going to call them ebooks, but they're basically what the old white papers that we used to publish a lot of stuff in text format about different things. And we're going to start taking Telechart 2000 and we're going to tear it apart. For those of you who use TC 2000, you need to learn some of the simple tools within it that make what we just talked about a lot easier. And we're going to break those down to how-to videos, and you can subscribe to the videos. So what I want to do is package those up, and you'll have access to them. We're going to look at how we can communicate more effectively with Twitter with you, that you can ask questions throughout the day and some of those types of things. So there are a lot of things that the reason I've been quiet is that I'm looking for ways that I can communicate more effectively. And, to me, there's a lot of issues in the marketplace today, and those are the things we want to see as we go along that are going to make us money. Now, somebody asked a question about high-frequency trading. I don't even want to get on that bandwagon. High-frequency trading is an issue. Has it affected ETFs? And, where it affects ETFs is in the leveraged ETFs, because that's where that high-frequency trading is. If you look at directions funds, even some of the ProShares funds, the reason the volume's so high in those is that's where the high-frequency traders are. Does it break them down? I don't think it does. I think in some ways it actually makes them better, because just as an example, TZA, which I think is the short on small caps, the Bear Fund, you can see that, this trades a lot of volume. I actually don't have a volume. Here it is. 25 million, trades roughly 20 million shares a day. I mean, to me, that's a lot for an ETF. But that volume actually makes the leverage work better than if the volume wasn't there. And that's one of the problems we've had with the egg, is that I'm better off trading directions funds with the egg than I am trying to trade XLE, because the high-frequency traders will mess with XLE a lot more than they're going to mess with other things that we see out there. So the thinner the volume, anything that trades under 1.5 million shares, high-frequency traders generally aren't involved in, but also trading under 1.5 million shares, for the volume of shares that we're trading, it becomes very difficult to do. So I think that, my focus has been to retool my whole mindset, focus on what I do best, and trade it. And I'm just going to show this trade because I know I get a lot of questions from people in email about how do you break this down. And I'm going to go into a 5-minute chart here. I'm going to go to the intraday, and I'm going back on Google. I'm going to go back to Monday. And here's Monday's trading day on the 28th. And you can see on the intraday trading that you can see this comes down, bounces, tests again, bounces, double bottom. I do a lot of pattern trading because in momentum markets, pattern trading works very effectively. When the markets become lethargic, the patterns break down. But when you get a market that's trading in a normal style, patterns work extremely well. But what we did was we took the entry on this trade. I can't show it very well on here, but we use a thing that takes the first 30 minutes of trading. If you get an intraday reversal and you break back above that high of the day on the first 30 minutes of trading, that's an entry point that we would actually buy Google. So at that point, we were at the 515 level on Google. We actually bought the 520 calls for June, and we bought them at $18. I'm going to round them off. There were some pennies involved, but so we owned them at $18. Our target was actually 538 on that move within Google. And I don't have time to get into where we got the target from, but we defined the entry point, we defined the target. The stop would have been a violation of this, and that would have been breaking the bottom 30-minute cycle right here, which was around 510.50. So, and because of the price of the stock is why we went to the options. That's the only reason I went to the options. Otherwise, I would have traded the stock. Because to buy 1,000 shares of Google, I got to put out $515,000. To control 1,000 shares of Google, I can control it for $18,000. And that's the only magic behind it. And so we took the 10, we only bought 10 contracts. This wasn't a huge trade because of the risk of the market around me. So I'm putting in 18 grand. I bought 10 contracts. And the way that we looked at this was yesterday, you can see that Google drove me crazy yesterday by the fact it traded between 523 and 528. I made a promise to myself coming into today that if we hit 530 on the trading day and did not break through it with any conviction in the first 3 or 4 hours of trading, that we would exit the position. So we sold the contracts at $21, which equates to $529.50 on the stock. And the high on the stock today was 531, and it could never get through it on any volume to speak of. It got through it at the close of the day. You can see down here, it got through it on the end of the day with a spike in volume, which generally happens at the close of the day. But that trade netted a $3 after trading costs. It netted a $3 profit, which equates to $3,000 on the $18,000 is 15%. That trade, Google trade, came from the egg scan on Monday morning. So what came up on the egg scan was the Qs, and within the Qs, we went and we dug through the Qs, which is 100 stocks, and we went through the stocks and we said which one of these offers an opportunity, and we had a list. There were actually 5 stocks: Priceline, Google, Amazon, Netflix, and I can't remember what the 5th one was now. But those were our 5 stocks coming into the trading day. We looked for them to set up. Google had the best pattern set up. Google became the trade. Now, Netflix, just so you don't think I'm stacking the deck here, Netflix was actually the better trade, because look at what Netflix did today. Netflix set up, it had a reverse head and shoulders on the intraday here. It got messy when it got to our entry point up here, and I didn't like the trade, and I kind of backed away from the trade. And the same thing, Priceline had a very similar intraday reversal. Here on Priceline, you had a cup and a handle breakout. Priceline was attractive. The options were a little bit rich. I don't understand why they were trading at a premium that they were, but Priceline was actually a better trade. Out of the 5 trades, Google returned the least return for what we would have gotten out of that trade on Monday. So I just want you to say, I'm saying this because you're always going to get the home run, but I'm not in it for the home run. I'm in it for the trade that's set up that I can take money out of, and that's how it works. It's simple, and sometimes I get the home run, sometimes I don't. But the whole idea of that trade was to make $2,500. It made $3,000. We took our money and we're out of the trade. And if Google goes up tomorrow $50 a share, I'll cry, but I'm still going to be okay with it because I got what I bought the trade for. And if I psychologically damage myself for all the manure that's out there, it doesn't work very well. Now, I said I was going to be short and brief tonight, and I've gotten on my horse, and I apologize, but for whatever reason, I get on these webinars and get going. Don wanted me to put this up for you. So if you're not a subscriber to the website, we're actually gonna make the egg a standalone portfolio that you can use just the egg. Some people, the reason I did this is I feel like if I'm going to talk about simplicity, and then I want you to buy the whole website, then I probably have destroyed any credibility about keeping it simple, even though I think the website tries to keep it simple all the way around. But this gives you one thing to look at. It'll be on one page. It'll have everything on the page. It'll all be in an Excel spreadsheet, and it's pretty easy to actually read. I think I have the web page up. But if you go inside of here, you can come down to One Egg Model, and that's what you'll see. The text will be there. Trade is posted. You'll get the text to it. And I'm going to add one little text box down here at the bottom now that will just update text relative to what's going on a daily basis. The other thing that we added to this is other eggs that we see throughout the day, throughout the week. Doesn't mean we're going to trade out of the egg we have. We're just going to show you what other eggs are popping up so that you can try to follow along with how the eggs are rolling, so to speak, not to be funny, but how to actually see how these evolve. When we rolled out the One Egg Model, we only scanned on Friday and we made a trade on Monday, and we didn't scan again until the Friday, and that's been true right up until now. So now we're actually running the scans every day. We actually run the scans sometimes intraday if we're looking at reversals on the market. So we've gotten a lot more aggressive at how, the scans work when you run them. They work the same way. The filtration process of the scans are all the same. We start with the positive and negative scans, and then we go from there. And so we actually filter it 6 times. So we start with 1,120 ETFs, and we filter that down, and then we filter it again, and we filter it again, and we filter it again. Each time it's filtering for a different criteria. And so it filters through 6 different processes, and each process, the reason you don't see them up here is that we start with, just to give you an idea of how we do this, is we start out, we filter it to 116, we flag them, we create a new watch list, and we scan them with a different scan. And then we flag them again, and then we run a different scan on those, and then we flag them again, and we run a separate scan on those. And what it gets down to is by the time I run the 5th scan is we have somewhere between 3 and 7 eggs. And then we take those, and that's where the human intervention comes, and we pick the best egg. That's why we had 5 stocks out of the NASDAQ the other day. I picked the stock that I thought was the one that fit what I wanted to accomplish. So it's pretty simplistic. There's no elaborate theory behind any of it. So with that, I'm going to shut up. If you have any questions, I'll hang around for a few minutes. If you don't have any questions, you can... I think my brother's going to put a landing page up here that you can go to. If you're not a subscriber, it's only $99 for a quarter. It is $99 a quarter ongoing. There are videos coming. There will be an ebook coming with it. There'll be a lot of stuff that's going to come with the egg as we go along. And so it'll start having its own educational portal, and we'll actually do a lot more stuff with Telechart with the egg than what we've done in the past. And the other models will stay the same. Nothing's really changing relative to the balance of the website. It will change going forward because we have some nuances of things that I want to do to simplify it. But the whole theme for 2014 is simple. Keep it simple, stupid. And the simpler I can make it, the easier it is for you to follow it, and the easier it is for you to ask me questions to get what you want out of it, because that's what this is about, is you basically obtaining what you want to do.